I'm Charlotte McLeod with the Investing News Network, and here today with me is Brien Lundin, editor of Gold Newsletter. Thank you so much for being here online with me once again.
Great to be with you again, Charlotte.
Yeah, really happy to have you on. We've got a bunch of things to talk about, and I'm hoping we can start off with something that is a little bit timely, which is the new COVID-19 variant called Omicron, and of course, the impact on gold. So you recently sent out an email newsletter that I found really helpful in understanding what's going on here. Basically, you said, yes, it's important for people to own gold, but you shouldn't be buying it in reaction to a crisis situation. So I wondered if you could start by going into why that's a mistake, because I think it's a really important reminder for investors today.
Yeah, really, I put out that advice for two reasons, one specifically and one general. Specifically, I thought the Omicron variant was going to be nothing of really lasting or serious significance because it seemed to be mild and highly transmissive. In fact, it was probably going to end up being a boon for global health because it would spread, at least to some degree, immunity without any or as much lethality or adverse reactions in people because it seemed to be much more mild. I said that a while ago and put it out in social media as an unpopular opinion, but it seems like the facts and developments are supporting that at this point. And that's, going to be the fact that it really isn't much to worry about. The other thing, more general, is that investors should never buy gold in reaction to geopolitical, or in this case, geomedical issues or crises or flashpoints, because gold really is not the thing to buy in that. There's no logical reason why people should want to own gold in those events. Why they should own gold, the reason why they need to own gold is not for these short-term issues and flashpoints, but for the longer-term trends of monetary debasement. When their home currencies are losing purchasing power at an accelerating rate. That's the reason to own gold, simply put, as an insurance against your wealth and everything else you own. And it's insurance not against something that might happen, like your home insurance is to guard against your house catching on fire, even though you don't expect your home to catch on fire. With gold, you're insuring your wealth and all of your worldly possessions, everything you've worked for, against something you know is going to happen. It's inevitable that your currency is going to lose purchasing power, and gold protects that over the longer term.
Okay, well, thanks for going over that. I think that's really key because it is so tempting to respond to those short-term factors. But what we should be paying attention to is the underlying factors that are going to have an impact on gold eventually. So let's talk about those a little bit. I know the US Federal Reserve and its actions are probably at the top of the list. Since we spoke last, we've had them announce a tapering plan, the plan for interest rate hikes next year. Do you think that sounds realistic? I really want to get your thoughts on those plans.
Yeah, it's realistic that they could try. I don't think it's realistic that they can get too far down the road toward normalization. At some point along that road, whether it's with tapering or the actual first rate hikes, I think that they're going to have to turn back. If they turn back during tapering, it would be because of some type of a taper tantrum at the markets, throw a hissy fit, and tell the Fed that they can't do it. They need that liquidity. They need more of the monetary adrenaline. If they get very far down actual rate hikes, they will run into the inescapable mathematics of the size of the federal debt today. The debt service costs, if the Fed were able to get to, say, 2% on the Fed funds rate, the debt service costs will rapidly approach $1 trillion a year. And that I don't think is politically palatable or acceptable. And people will start talking about, why are we even paying for this federal debt? Let's just go ahead and default. I don't think they can get to that point, but I think you'll have some political talk about that in this kind of a political environment that we're in, and that alone would be very detrimental for the US dollar. So I don't think they're going to get very far if they start hiking rates. And as we've seen, the first rate hike is actually a point where it tends to mark a bottom in the gold price. The gold price tends to recover after the first rate hike because all of the people who were shorting gold, all the traders who were shorting gold in anticipation of the Fed hiking rates, then kind of abandoned that trade and they released the selling pressure on the metal. We saw that in December of 2015. That marked the bottom of the gold bear market. And the recovery since then has been stop and start. But at least immediately following that initial rate hike, we had a tremendous run in gold. And I think the same thing is going to happen when and if the Fed actually gets to the point where it can start hiking rates in this cycle.
Right. And it's kind of interesting to look at this proposed schedule because it seems like the Fed has kind of built in the possibility that it might slow down, it might go backward just by using language to say that type of thing. So how do you think that impacts, the response from gold if we already are kind of thinking, it might not go as they've said it will go?
Yeah, the Fed has power now that it didn't have back in the old days of being able to talk the market in various ways, the power of its rhetoric. And with the market so dependent on Fed policy and following it word by word and hint by hint, that is a lot of power now that they didn't have many years ago. If you want to look back to a time similar to today, you have to look back to the 1970s to find a period when real rates, interest rates adjusted for inflation as denoted by the consumer price index, were as low as they are now. Right now, we are at record levels or at levels that equal the lowest real rates that we saw during the 1970s. So it's a similar situation in that respect. And it leaves people wondering, why aren't gold prices rising like they were in the 1970s? And that, I think, is the real issue today. Why aren't we seeing much stronger markets? And I think there's a lot of factors behind that, but the rise of the paper gold and paper silver markets, I think, are what's really holding it back. And of course, those markets are dependent upon the Fed or closely watching the Fed and the Fed's rhetoric. So it's a good point that the Fed, by accelerating tapering or pulling back on the throttle, will have an outsized impact on the markets these days. But I think eventually gold wins because the markets are going to realize the Fed's essentially powerless to defeat inflation or even fight it in any significant way.
Right. And going back to a conversation that we had this past August, you said it's pretty typical when the Fed is shifting its messaging to see some weakness in gold prices and silver prices. And typically when you see action, and this time it could be either in, going forward with tapering or with rate hikes, and then that might be when you see moves in the precious metals. Now that we have tapering going on, is it safe to say that we need to wait now for the rate hikes to see some upward momentum?
Yeah, I hate it the way you always bring up what I said the last time, Charlotte. You hold me accountable so much. But yeah, I had thought back then when last we spoke that perhaps this time around, because things are moving much more quickly now than they did, say, post 2008 and subsequently, that perhaps the announcement of a tapering schedule, the announcement that they're going to be tapering, would be enough to light up gold this time around. And it actually did for a few days. But then Biden came in and reappointed Jerome Powell as Fed chair. And apparently the markets didn't like that because they thought that Powell was hawkish somehow. And in fact, he's the most dovish Fed chairman in history. But they had wanted Lael Brainerd, who apparently would have run an open checkbook policy, et cetera, et cetera. That was kind of the Hail Mary bet on gold at the time. So they abandoned that trade when Powell was reappointed, and gold took another hit. And that's kind of where we are now. It took a hit in sentiment, and everybody's bearish on the metal right now. And tapering, that boost we got from the tapering announcement wasn't quite enough to keep us going. I think the Fed rate hike will be enough. That's probably going to happen if they can get to that point about mid-year next year. And so sometime between now and then, I think we'll see the bottom in gold. In the meantime, there are some catalysts out there that could get gold moving. The CPI, number coming out next week. A few other things like that. Any other Fed announcements? A taper tantrum would be bullish for gold as well.
Right. And do you have any thoughts on this renomination of Jerome Powell as Fed chair? What do you think that could mean, if anything significant?
Yeah, he's the dovish, as I said, the dovish Federal Reserve chairman in history. I think he's going to continue along that path. And the only way that he seems hawkish is in relation to somebody like Lael Brainerd, who was a bit more dovish. So it's all relative. I think he is dovish, but it doesn't really matter because the Fed as an institution is tracked. They can't raise rates to any significant degree because of the burden of the federal debt levels. And there's no, we had a similar situation in the 1970s as far as negative real rates and rising inflation. But back then we didn't have these debt loads. And we also had Paul Volcker. There's no Paul Volcker out there, and it certainly is not Jerome Powell. So I don't know if it really matters who is going to be the head of the Federal Reserve. There's no one there that is going to tank the U.S. economy by raising rates to the extent where it's going to have any kind of an effect on the rate of inflation.
Right. And let's get your updated thoughts on inflation. It's definitely tied into everything that's going on here. And we've been listening to this confusing narrative from the Fed. So what are your thoughts on where we're going?
My thought is that the last read we got for October and CPI was very hot, obviously. I think there's a risk for the gold market in the short term if the next number, the November CPI, doesn't quite live up to that benchmark. If it's still hot, I think it's still going to be hot, but if it doesn't quite meet or exceed what we saw the previous month, there may be a bit of a letdown in the market and some belief fostered that perhaps inflation is moderating. So that's a risk in the near term. One of the key factors in the CPI that is yet to be fully appreciated or factored into the calculations are rents or in real estate prices. Real estate prices have been soaring. Home prices have been soaring in the U.S. for some time now, but that hasn't trickled down to rents, which is the only thing that is actually tracked in the CPI. Housing is a very large component of the CPI, but it's tracked as owners' equivalent rents. And that takes a while before that filters into the calculations. That's coming up. Whether it happens in this month or the next month, I really can't say, but that is a big factor that's coming up that will actually increase the rate of inflation at some point.
Right. As I have these conversations with people about inflation, one thing that keeps coming up is that it's not being recognized by the mainstream, although people can feel it when they go to the store. People like you are telling me that this is real. So do you think then that mainstream acceptance is coming when the rent comes through to the CPI?
Well, when that happens, we'll see it in the CPI, we'll see it in the data, in the numbers, and it will be hard to refute. But the pain is already being felt by anyone who's trying to buy a home or anyone who is renting. They're already seeing that. The pain's also being felt at the gas pump and in other places, in grocery prices, by mainstream, by everyday Americans. Where it's not being felt are by pundits who ride to their studios or offices in limos that are supplied by, big corporations. So I've seen a good bit. I've gotten in a Twitter spat here and there with some of these big time pundits who are talking about how gasoline futures are actually declining. Well, they're not declining at the pump for everyday Americans, and they'll make arguments that inflation really isn't that bad right now, but they'll post annual charts of inflation that don't show what's been happening over the last 6 months. So a lot of misleading information out there, and a lot of people out there becoming apologists for current monetary policy. And the people, mainstream people, are really feeling it. And inflation, we've seen, disproportionately affects the middle class and the lower economic classes, more so than the rich people. The wealthy have ways to not only avoid it, but also profit from inflation. Everyday people don't have that ability. So it is a tax on the lower half, the lower 2/3 of the economic scale. And, and so it's something that's already here. The data will convince Wall Street, but everybody else is already convinced and feeling the pain.
Right. And so for gold and silver prices, as we move into 2022, are we kind of still in this holding pattern where the short term is uncertain, but we know that the longer term looks brighter?
Yeah, I think so. The sentiment right now in the metals complex and in miners as well is abysmal. Even, I'm bearish in the near term. I'm not very excited about it. And I find that when I'm bearish in the near term, it's usually a good contrary indicator, and that's when gold tends to turn around. So, we're stuck in December. We're in tax loss selling season, at least for the miners. Sentiment in the metals is terrible. Yet we're about to enter a traditionally strong period for the metals in early January and early part of the year. So this is typically the time when people should cherry pick the best buys and position themselves. Sometimes the metals will post a 10 or 15% move before the new year in the last couple of weeks of December. So the odds favor, the record favors that we'll have a strong January and February for whatever reasons, for whatever catalysts may emerge. And if you want to hold the metals and the miners for the long term, this is probably a good buying opportunity around these levels. And where it's the case where you need both courage and cash to take advantage of opportunities like this.
Okay. And one side question on the mining companies right now. We've been hearing so much about how inflation is affecting everyday people. What about these companies? Is it something that's now starting to come through to their businesses as well?
It can. We haven't reached that point where it's had an outsized impact. One of the things that's important to remember is back in 2010 and 2011, we had soaring gasoline prices at the same time that the gold price was soaring. So the big producers, the big miners who had to fuel up a lot of those big yellow trucks were feeling the pain in their operating costs, and their margins actually shrunk as the gold price was rising. So the big miners actually underperformed the metal itself, which was a rare phenomenon in the history of gold and mining investment. But it happened, and it could happen again. The miners, the big producers, have cleaned up their balance sheets and their operations a good bit since then. So they're better prepared for that right now, but it is something to watch, and a good point.
Right. And are there any other trends that you would point to in the mining sector as a whole as we head into the new year, things that you're watching?
Well, if we're going to get a surprise on the metals prices, on gold and silver, then we will see the companies that have large resources respond to that more quickly. The optionality plays. So it's typically a good time from a contrarian point of view to buy those optionality plays. There are, however, a number of companies that have big resources and big drill programs at the same time, and they will benefit from both exploration news and those resources. So that's kind of an area we're trying to focus on in Gold Newsletter, and have been making some new recommendations along those lines. And that's what helps insulate some of these plays from, downturns in the metals markets or a lack of positive sentiment in the metals markets. Good drill results will almost always get the market's attention. So it's a good way to hedge that and focus on companies that are having active drill programs.
All right. And as we wrap up, one of my favorite questions to ask at the end of any year, What's your best advice heading into 2022 for investors?
Oh, thank goodness. I thought you were going to ask me for a specific price prediction. But the best advice I have is for people to maintain exposure, actively trade make investments, but actively trade them as well. But make sure you are taking advantage of these levels to get involved in the best mining stocks, and make sure you have an adequate holding in physical precious metals, gold and silver primarily. But take advantage of these downswings, build nice size positions in the best junior mining stocks, because I'm looking at perhaps 6 months down the road where we'll see the Fed try to raise interest rates, and that typically sparks a very strong rally in gold and silver, and that's the kind of thing we have coming up. It's not immediate, perhaps, but it is a kind of a situation that could be very compelling and foster a very large move in the metals and miners. So it's a great time to prepare for that.
Okay, well, thank you so much for that. I think that's great to consider as we're heading into the new year. Great to speak to you. Thanks so much for coming on.
Thank you, Charlotte. Always a pleasure. Appreciate the opportunity.
Great. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Brien Lundin of Gold Newsletter.